Welcome to quantifiedstrategies.com. In this video, we'll explore 3 long-term trading strategies that work. They are simple, practical, and backed by data. These strategies aim to reduce drawdowns, ride bull markets, and even outperform the markets with less stress. Let's jump into strategy number 1. The 200-day moving average. The famous investor Paul Tudor Jones once said that the 200-day moving average is the first indicator he looks at. Why is that? First, let's see what it looks like on a chart. The red line represents the 200-day moving average. It lags behind the price since it's based on historical data. One thing to notice is that when the market moves sideways, the indicator produces a lot of whipsaws. So why does Paul Tudor Jones use it? Because it keeps you out of trouble when a major bear market hits. We're going to show you how trend-following strategies use the 200-day moving average, and how this same indicator can be used to filter short-term mean reversion trades. Here's a simple strategy. You buy when the S&P 500 is above its 200-day moving average and sell when it drops below. Since 1960, this strategy returned 6.6% annually, almost as good as buy and hold's 7.1%, but with far smaller drawdowns. Only 28% versus buy and hold's 56%. You are invested about 70% of the time, and thus can make interest on your deposit when you are out of the market. Take a look at 2008. This strategy had you exit the market before the financial crisis and re-enter in 2009. You avoided a 55% crash. This is why Paul Tudor Jones loves the 200-day moving average. Once the dust settles, you're compounding from a much higher base. The 200-day moving average also works great as a filter for short-term strategies. In this mean reversion example, we buy when RSI 5 dips below 35 and sell when it goes above 50. While the equity curve looks decent, the drawdown reaches 31%, something that would make most traders quit. But let's add the 200-day filter. We only trade if the price is above it. The result? A smoother equity curve because the average gain per trade increases while the drawdowns are significantly reduced. Only 14% in drawdowns are quick to set new highs. That's a psychological advantage, as most traders find losses more painful than they enjoy wins. What happens if we flip the filter and only trade when below the 200-day average? Performance becomes more erratic. And that's no surprise because volatility is twice as high when the price is under the 200-day moving average. Strategy 2. The Golden Cross. This strategy helps you ride bull markets and reduce losses in bear markets. It's based on the well-known Golden Cross. A Golden Cross happens when the 50-day moving average crosses above the 200-day moving average, signaling a bullish breakout. A death cross is the opposite and signals a bearish phase. But why use it? The stock market generally trends up over time due to inflation and productivity gains. The Golden Cross captures that trend while helping you sidestep major crashes. You buy when the 50-day moving average crosses above the 200-day moving average, and sell when the 50-day crosses below the 200-day. Let's see an example. In July 2020, the 50-day MA crossed above the 200-day MA. Buying here and holding until March 2022 would have netted a 32.4% gain. So how does it perform long-term? We backtested the strategy from 1960 on the S&P 500. It made just 33 trades, each held for roughly 400 days. 79% of the trades were winners. Average gain per trade was 15.7%. The annual return was 6.7%. Slightly below buy and hold's 7.1%. But remember, the strategy was only invested 70% of the time. Max drawdown? Just 33%, compared to 56% for buy and hold. That gives a better risk-adjusted return, 9.6%. Strategy 3. The 2 ETF strategy. This strategy is as simple as it gets. Once a year rebalancing with 2 ETFs, TQ and BTL. TQ is a 3 times leveraged ETF tracking the NASDAQ 100. BTL is an anti-beta ETF that tends to rise when high beta stocks fall. Together, they offer a blend of aggressive growth and crash protection. Here's the rule. In January each year, Rebalance to 33% TQQQ and 67% BTAL. That's it. Why this works? TQQQ gives you massive upside when Nasdaq trends up, but it's risky. BTAL acts as the hedge. It tends to spike when high beta stocks drop, offsetting TQ's losses. Annual rebalancing also avoids volatility drag, which is common when rebalancing more frequently. We backtested this long-term strategy from 2012 to today. Annual return, 18%. Max drawdown, just 28%. It beat Nasdaq in 8 out of the last 13 years. But be aware, TQQ is leveraged and risky. It's built for short-term trades, not long-term holds, and always factor in fees and taxes with leveraged ETFs. Still, the combination of upside and protection makes this strategy hard to ignore. Like this kind of content? Then hit that subscribe button. That wraps up our 3 long-term trading strategies. Whether you're into trend following, moving averages, or ETF combos, there's something here for every long-term investor.